Welcome. This is Tommy Ruke again with Part 3 of Inland Marine Coverage Consideration. These seminars are provided by the Motor Carriers Insurance Education Foundation and the TRS Specialist. If you have a problem during the program or have a question during the program, please type in the chat window the questions and we will attempt to ask them during the presentation, or if not, afterwards by sending an email to you and, if appropriate, to all participants in the program. If you have any problems with the mechanics of the presentation, audio or other, please again type into the chat window, or if not available, call our number at 800-741-4084. Now let's move on to the presentation. Quick review. Motor carrier, like all insureds, will have some property to cover. The first consideration that we talked to in section R1 was the building and the personal property and personal properties others that were within 100 feet of the premises. We talked about covering them with a basic coverage form, the commercial package policy, or a business auto or a business BOP policy that address these items. We found out that there could be a conflict between the commercial package policy and the marine policies that we were talk about writing, in that the definition of covered property could be met under both forms. So we looked at when the policies would respond, and we found that the marine policy would respond first, and the commercial package policy would respond second. So we look at the coverages to determine how they would apply when a loss happens, and understand that the policy that covers the item more specifically, meaning the inland marine, which would be the computer policy, the contract equipment policy, the forklift equipment policy, or later the cargo policy, that it would pay first, and then the commercial package policy would step in and pay an excess if needed to complete the reimbursement of and the indemnification of the insured for the lost items. We also explored the problem where we have trucks with equipment on them. We have cranes, we have pump out items. In some cases we have auxiliary power units, other things attached to it. We found that looking at the business auto coverage forms, the physical damage in them, and the auto forms, that it covers the auto and the equipment. The marine form covers the unit itself, which would include the equipment attached to it. And we found out how to look at those items and determine not to split it between one and the other, cover it on the areas that are more appropriate. And we found out that the physical damage coverage in the auto form is the best coverage. It might not be the best premium, but the best coverage. And then marine form is not dependent on location. That's the key. The term marine means floater. It covers the property wherever it's found. Also, the forms and the rates are not required by most insurance regulatory to be found as the requirement for the commercial package policies or the business auto, general liability, and other found forms. This leads us to the transportation exposure, because the transportation exposure does address property away from fixed location, which brings the inland marine policy necessity in play. We found out when we look at motor carriers that a private motor carrier and for hire. The private motor carrier is providing transportation for cargo. The for hire motor carrier is providing transportation for cargo. The inland marine coverage forms, which now we'll move to call them cargo forms, will address this exposure. The private carrier is protection of their own property. They're taking their contents, they're taking their manufactured items, they're taking their raw material that they own from one location to another location or to an ultimate distributor, but that cargo they own is in their care control away from their premises, and those items need to be covered. A for-hire carrier, though, is hauling someone else's property. They are a bailee, so therefore they have bailee responsibility, which means that they must take prudent care of the property in their possession. We found in the coverage forms to address this that we have two. a coverage form that's called the transit form. This is protection of property, owner of the property, no matter who is providing transportation. We found that this is found in some other areas, such as a BOP policy or an extension in the CPP policy, or even a homeowner's policy. We went through those examples that would cover the owner of the property when someone else is providing transportation. We also then have the motor carriers form. That's the policy that addresses the insured who is providing the transportation. So the transit form covers the owner of the property, no matter who is providing the transportation, where the motor carriers form, the insured on that policy is the means of transportation, the entity who is providing the transportation. A for-hire motor carrier is responsible for damage to property they are providing transportation for. Again, that's a bailee. That's common law to take prudent care of it. Now, that law can be modified by a contract. In the arena we're dealing with here, the contract is the bill of lading, the agreement between the owner of the property who is requiring it to be shipped and the motor carrier who is providing the transportation. It can be a specific item covering the contract for carriage on that specific load, or it can be complemented by a general hauling agreement between the two parties. That contract spells out liability, but there's also federal regulation, and we're going to spend a few minutes talking about how the federal government steps in and determines. Again, this is for interstate regulated hauling property for for-hire truckers. The prevailing law is called the Carmack Amendment. This Carmack Amendment is an old form. It was first promulgated in 1906 that dealt with water transportation, and then brought the motor carriers industry in 1935. It was adapted to provide uniform ruling as to how interstate shippers and shipments would be handled. Its first design was to protect the motor carrier, not the shipper in this instance, so that there is a way that the motor carrier understands their liability and can address that or be aware of that liability as providing transportation. The Carmack Amendment spells out the rights, duties, and liability of shippers and carriers. In other words, it's a bilateral discussion about responsibility and duties for each party. And it covers it when there is a cargo loss of property in interstate commerce. Now, who is subject to this? When does the Carmack Amendment apply? The Carmack Amendment applies to shippers and carriers involved in, again, interstate shipment of all commodities except farmers, fishermen, and other categories. What we deal with today, remember this was written in 1935, we deal with today called regulated commodities and exempt commodities. The Carmack Amendment does not apply to exempt commodities, just to regulated commodities, and these are the processed goods. So farm products, fish, and those items are not subject to Carmack, but all others are. Also, please note that Carmack is also not subject to intra-state shipments, just interstate shipments. We could have a situation where your insurers get involved in something called a through bill of lading, where they do local delivery that would bring that shipment, even though it's not your insured moves it between points in the state. But since it started from another out-of-state location or out-of-state location to that location, and your insured does the further shipment, it still could be an interstate commerce. It's not where the truck goes, but where cargo goes. And here's the key. Who's liable for cargo damage under the Carmack Amendment? The Carmack Amendment holds the motor carrier liable for damage to goods and transportation. Absolute, strict liability without proof of negligence. In other words, they're liable when it's in their possession, no matter what happens to it, and they provide the services that they are engaged to provide, moving it from point A to point B, and is expected when it gets to point B that it's in the same condition that was given to them by the shipper in point A. They're absolutely liable except for the 5 exceptions we'll see here. Those 5 exceptions are acts of God. Wind blows over a trailer, a tornado, a flood, But here's a case that came to me, which was unique. A motor carrier was hauling actually food goods, and the driver had a heart attack. The driver ran off the road, damaged the goods that he was hauling. Unfortunately, he even expired, and the insurance carrier denied coverage because they said that was an act of God. I think that is pushing it too far. And later, the insurance carrier did come back and pay the claim. One other thing about this area is the acts of God also, though, requires the motor carrier to attempt to protect the property, meaning that if we hear a tornado is coming or hear a flood's coming, or in the cases where I live in Southwest Florida where there is hurricanes, we just can't leave the trailer, leave the loaded carrying compartment out in the area and walk away from it without taking prudent care to try to protect it from those areas. But the act of God, you obviously can't be liable for the acts of God, but that is one exception. The second exception is public enemy. That's war. These things are added. Again, remember, this is 1935, when there could be have a indication that war would be coming to the U.S. I don't think we are quite as concerned about that as there. But if war, public enemy damaged it during an insurrection or war, we would not be, the motor carrier would not be responsible for it. The most common exception to the CARMAC that is pleaded the most often by the insurance industry that says the motor carrier is not liable is the act of default of the shipper, and sometimes referred to as the negligence of the shipper. What do we mean by that? If the motor carrier picks up a load and the shipper is responsible for the packaging, and the packaging is not properly done, therefore the shipment is damaged, then the motor carrier can say, I'm not liable for it because, shipper, it was your responsibility to package it. You packaged it wrong. It got damaged not because of something I did, but because of your faulty packaging, then it's not liable. Second thing is the shipper tells the motor carrier and puts the wrong address, or tells the motor carrier when delivery can be made, and when they get there they can't make it at that time, therefore causing damages. Or again, the negligence of the shipper. The motor carrier would not be responsible for that in that case. We had a case involved here. Later we'll talk about it in IR4 about coverage, but most of you are all aware of this type of coverage, where if the items are temperature control, therefore there must be a endorsement of the policy called mechanical breakdown in most cases. Not all cases, but in most cases. There was a shipment of gladiolus bulbs out of Houston, Texas to Palatka, Florida. Big flower industry in Palatka, Florida. Gladiolus bulbs are annual, so therefore after the season's over, they're harvested, they're kept in a dry environment, and then they're shipped to the farmer to put in the ground for shipment. The load was picked up by a motor carrier in Houston, but when they got to Palatka, they were sprouting. So one of the agents who I have a relationship with, who is a part of the foundation, called me up, and I love it when they call me up and says, Tommy, I already know this answer, but I just want to verify. We have mechanical breakdown coverage, and when the item got there it was sprouting. I said, well, why was it sprouting? And he said, because the driver never turned on the refrigeration unit. My first comment is then there's no coverage under mechanical breakdown because you must prove breakdown. But however, look at the bill of lading. See if on the bill of lading did the shipper tell the driver what temperature the bulbs had to be kept at. The agent went to their insurer, the insurer looked at the bill of lading and found out that the shipper gave no direction of care of temperature requirement for that. So the conclusion here is there's no coverage, but the insurer is not liable for it because the shipper did not tell the motor carrier, tell the driver what temperature the goods had to be kept at. So therefore they had no liability. That's again the negligence of the shipper. Now, in this case, obviously, it did not make the shipper happy, who was the customer of the motor carrier, but that's how this could work. The other two, again, are public authority. This happens like when 9/11 happened, or hurricanes in Florida, or tornadoes where there's geographical areas that are damaged. Again, truckers could not get into the south of the New York City area during those traumatic times. The weather did not allow some deliveries to be made, even the snow and other items, and therefore the government says these areas are quarantined, these areas you can't not get through, these areas are a hazard, and for some reason the loads get damaged during that. They're not liable for it because they could not deliver it as required because the government would not let them do that. The last one is inherent vice, or the nature of the goods in transport. This recognizes that there are some items that would fall subject to this that could absorb moisture or lose volume depending on temperature, like we deal with gasoline and other liquids. Those items can shrink or expand depending on the temperature they're being held. Things like batteries and all that in itself deteriorates in time, that has to do nothing with the truckers. The bottom line, though, is the Carmack Amendment makes a for-hire motor carrier hauling processed goods in interstate commerce absolutely liable for the cargo they're hauling, except for these 5 exceptions. And the only 2 that are relevant that happen in most cases are the acts of God. Again, there is limitations on that because the insured must avoid the acts of God if at all possible, or the shipper did not tell the motor carrier or the driver where it was going, or mispackaging, or did not tell the care that needed to be done. Other than those situations, the trucker is absolutely liable under the Carmack Amendment. Now, the shipper has responsibility. To hold a motor carrier liable for cargo damage, the shipper must provide that the goods were in good condition when received to the shipper, or given to the shipper. The goods were damaged when delivered or were not delivered, and the amount of damages. So the shipper has to prove that the motor carrier got the items in good condition, that they were delivered damaged, and also spell out the amount of damage that's done. So that's where they file the claim. So also, how much damage is a shipper liable for? The Carmack Amendment limits the motor carrier's liability to the actual loss of injury to the property, meaning the direct damage, not the consequential damages. Courts have generally interpreted this to be the difference between the market value of a property in which it should have if it arrived at the destination without being damaged, less now what it's worth, the actual value now that has arisen. So it's direct damage itself. Repair, replace what's there, not the consequential damages, because later we'll talk about loss of market and consequential damage in those things. But that is a major positive provision for some motor carriers in limitation of their liability, not being responsible for consequential damages, just for direct damages. They will allow for something called a release bill of lading. We talked about that before. This is where the motor carrier can say, I don't know what the value of those items are. I will not be responsible for more dollars than X amount of those values. Therefore, I request you, shipper, to release me from liability above a fixed amount because I cannot price that properly. This is the consideration there, and the shipper could agree for the lower rate or the rate done and agree to release the carrier liability for cargo. Again, we pointed out this is very common in moving and storage in the airline industry and other public transportations like that, in container industry where we don't know, it's hard to place, or it's hard to place a value on what's being hauled. So the trucker can limit their liability with an agreement with the shipper and have a release bill of lading, which is acceptable under the Carmack Amendment. Now, once the claim is made, the motor carrier has 3 choices to determine if they can have to pay or not. First off, they pay the full value of the cargo claimed by the shipper. They claim one of the outs, meaning one of the 5 exceptions: acts of God, war, shipper negligence, inherent vice within a product itself, or public authority, or pay whatever limitation they might have in a release bill of lading. Those are the 3 options. But there's also requirements for the shipper or the owner of the property to make a claim. A carrier are permitted to limit the shipper time they can file a claim to 9 months from the day of delivery. Once it's acknowledged they deliver, then the receiver, the owner of the property, has 9 months to file the claim. The timeline then from a lawsuit is 2 years and a day is the limitation after the claim is denied. Now again, there's 2 time frames. The 9 months is when delivered. Obviously, if the claim is filed within that 9 months, then it can go forward. It might take months, some periods of time, for the insurance carriers to determine if there's coverage or not, or the motor carrier determines if they're going to pay or not, and then the claim is denied. Once the claim is denied, then the motor carrier, then the owner of the property, the receiver, has 2.5 years to file a claim. Carriers must incorporate this in their bill of lading, which is typically done to enforce this time lane. The claim to the motor carrier under the Carmack Amendment has a shipper to be done. They can do it in writing, electronic communication, include sufficient facts to identify the shipment, meaning date, when received, when it's supposed to be delivered, what property was there. They can assert liability against the carriers for loss, meaning here's the damage, here's how much the damage was done, here's the delay, and then they make a demand on payment. So they have a responsibility to file the claim within 9 months. That once it's denied, to have a lawsuit within 2 years and a day, and they must be specific in filing the claim, letting the motor carrier know exactly what shipment was damaged, what items of that shipment was damaged, how much damage was done. But now we have a bill of lading. This is the Federal Act. We say we incorporate the Carmack Amendment in the Federal Acts. That's the bill of lading. That's the contract for carriage. And in those cases, the contract can extend or overrule any provisions in the Carmack Amendment. The contractor language used will incorporate the Carmack Amendment for interstate moves, and that's what is done in the Uniform Bill of Lading, even for exempt commodities, meaning agricultural products. You can incorporate the Carmack Amendment by the Bill of Lading, which has the mutual party, the receiver, and the hauler, the motor carrier, agreeing to those things. The contract acts also waive any rights and responsibility under the Carmack Amendment. This waiver must be expressed, and again in writing, and if waived, the parties are limited to the terms of the contract now or state laws that would fall in handling the claim, and therefore the Carmack Amendment would be modified or voided depending on the writing of the property, and the cargo loss and damages could be modified both in delivery of the time to make a claim and what the motor carrier is responsible for. So you can extend the Carmack Amendment for agricultural products, or you can modify it for other products, so it can go either way. How does the motor carrier establish responsibility? The contract of carriage. Well, again, through a tariff. The tariff is a document that spells out what the motor carrier services are being provided and at what price and what care of the cargo they're going to have for that price. Most motor carriers, based on the opinions that we have and based on the opinions of lawyers that we deal with that are contributors to the foundation, suggest that all motor carriers have a tariff. In the old days, back in the 80s, back before Ice-T, where a rate had to be filed and the federal government had to approve those rates, and part of that rate filing would be the tariff. That tariff was available for public review through the ICC, the old Interstate Commerce Commission. Again, that was done away with in 1995. Today, to be published, it can be on the motor carrier's website, Or it could just be where if the shipper asks for it, they can pull it out of their drawer and hand it to them. But they need to, in the bill of lading, say, this shipment is subject to my tariff. And this would then include the care and the responsibility of that. So the bill of lading should say, for the transportation, subject to tariff, addressing the transportation of the regulated party. The uniform bill of lading that we find and have used in the talks builds that in. It's only the individual bill of ladings that would not have the Carmack Amendment built in. So we need to have the contracted carriage refer to a tariff. Motor carriers should have a tariff to spell out not only what charges they're going to charge the customer for, but also how they're going to take care of the cargo and what the coverage, and invoke that this shipment is subject to the Carmack Amendment. But the Carmack Amendment can be waived, so the contract to carry states the Carmack is waived. Then the term and care set out in the bill of lading will address responsibility, not the Carmack Amendment. My concern in this is who controls the contract. Who's the person who's responsible here? Is the shipper or the broker? They have their own contracts. The motor carrier would not often have their own contract. They could, in their term, when they sign the contract, fill in the responsibility, or their responsibility is limited to the tariff, that their own tariff, but that's a concern. So as we deal with this, we need to deal with the motor carrier to look at the contracts they sign, to find out what contracts they're signing, how they address the Carmack Amendment, and how those bill of ladings are spelled, and encourage the motor carrier to have a tariff, and when all possible to invoke the tariff, which should include the Carmack Amendment in any of the shipments they've done. That's the best for everybody. So when we underwrite and we have claims, we need to determine, was the shipment subject to the Carmack? Your claims department handling cargo needs to know this to properly handle the claim. Was the tariff established, and in that, or which established the Carmack, or was it waived? We don't know this, and that's one of the problems that we have in claims. You do not know what the motor carrier might owe, what damages as an insurer of the motor carrier owe, until we find out the bill of lading, major instrument. What is the trailer? What's in the trailer? How does the driver verify what's there? We talked earlier on, and we will talk later when we deal with work comp and other areas, of something called a drop and hook operation. A drop and hook operation is your insured comes in the yard, and the trailer they're hauling is already loaded, is loaded and sealed. In those cases, the driver does not get a chance to see or to count or to view the cargo. We need to encourage our drivers, when they do that, to note on the item when they receive it, and again, they have to sign the bill of lading and make acknowledgement that they received it, that they received it with the shipper loaded and sealed, meaning they did not have an opportunity to inspect or to count the cargo, but it was sealed. They also need to make sure that the seal number is on that bill of lading, and when they deliver it, they need to find somebody at the delivery location to note on the receipt of the items that the carrying compartment was still sealed with that seal number on it. That prevents us later to determine, well, what happened to it? I was in a case involved where exactly this happened, but the argument we had and the out on this is, we have a receipt here that says I received the goods and the carrying compartment was sealed. I have another receipt where it was delivered and it was still sealed with that seal number. So therefore, we're not liable for the theft of the items within the container. That's our best defense. But again, drivers need to take time to make sure those items are done. We also only pay for direct damage, not the consequential or loss of use. What does this mean? Dollars to replace the property like you received it. However, we have things that are just on time delivery or other items. If a factory cannot operate or store has nothing to sell because the motor carrier did not get to the location on time, If the Carmack Amendment prevails, you can say, sorry about that. We're not responsible because of Carmack. I actually had this happen one time, shipping a load of books from Fort Myers, Florida to San Francisco. For some unknown reason, they got delivered at a wrong hotel. I had to teach that. I called up Federal Express and said, Federal Express, I don't have my books. They said, well, we'll pay to replace them. I said, you can't replace them. I've got 20 people here that paid me to be here. You owe me that. They says, no, we don't owe you that. All we owe you is for the replacement of the books, not because you don't have the material to teach. Fortunately, in this case, we found them, but by the same token, that's what it is. We're not responsible for it. If item is damaged and after repair, it's not worth the same. Sorry about that. This is major for the auto haulers, where you have the loss of market event. It's also here again on just-on-time delivery. So this is a major protection for the motor carrier, not being responsible for the loss of income, the loss of market, the loss of value, the use of the item if they do not deliver it on time, if it's damaged when it gets delivered. All we owe from under the Carmack Amendment is owed is the actual damage and what it would take to put it back in the same condition it was upon receipt. So the claim happens. Who owns the property that was damaged? It's the insurer's customer. This is why when we do presentations, I talk about that this is the most important claim that you can handle. And as a retail agent or an insurance company who's listening, it's extremely important to have insurers who understand that the cargo that's being hauled is the cargo of their customer, and if those items get handled or gets damaged, then the handling of the claim is extremely important to keep the customer relationship. If a claim is not handled to the satisfactory of the owner of the property, the customer, the claim handling, how it's done, could damage the relationships with the insured and the motor carrier and their customer, which has consequences far beyond the payment of the claim, far beyond even liability and physical damage claims. So going in, we need to understand what the expectations are, how coverage is afforded, and we're going to talk about that in hour 4, and know that other beyond any ordinary reason to be prepared to pay the claim. The claims, the customer's expectations are what's spelled out in the bill of lading, and they expect everything to be covered. What is the exposure that we have under cargo? What is being hauled? Items can vary by perishability, by breakability, by things like that. It's important for us to know what's being hauled. Those things we can find out from an insurance agent standpoint by asking the insured, asking who their customers are. We can look at SAFER. We can look at CAB or carrier's leads reports that say what the DOT officer notes as a customer on the bill of ladings to know what they're hauling. What carrier does the property require? Again, temperature control, flatbeds to be tarped, items that might be involved as far as breakage, and we have some requirements for the trailers have to be air ride trailers and things like that. And then what can happen to the cargo itself? What exposure to loss does it happen? We have the major 3 exposure to losses are crashes, theft, and then less than that where you have a fire or some item, vandalism or some items like that. So when we look at the insurance consideration, we look at the cargo and we say property being transported. Who owns it? Again, is it a private carrier hauling their own? Is it a for-hire carrier as a bailee? Or are they doing both? Today, as we know in the marketplace, a lot of private carriers with large trucks deliver their own property from one location, but they need to maximize their use of their trailers and trucks, so they will haul somebody else's property back. That's, as you hear, is a backhaul. We need to determine that. The more modern forms that I'm looking at that we're seeing, again, we'll get to that next in the last 4 hours. The coverage is for any property. Don't define owned or non-owned, but unfortunately, but you need to watch it. There's still some markets out there that say we only cover other property, not owned property, and vice versa. What's being hauled? If you want to drive your underwriter crazy, put general commodities. We got to know more than that. When we're looking safer, we see general commodities, what that means. Or when we're looking safer, we see the insured checks everything with 4 trucks. Machinery as well as animals as well as refrigeration goods. It can't be done. So we need to be specific what they haul within certain categories. We'll talk about those too, because that's what the insurance carrier wants to price and underwrite, is based on what the items being hauled are susceptible to losses. And in those losses, we need to understand and price based on those. We must describe in the insurance agreement what is being hauled. We need to be watch specific. You don't put Kleenexes if they're hauling paper goods. One example that I used in this, and actually came to me from an agent talking to me about it, is that they were hauling motorcycles for Harley-Davidson out of Milwaukee. The cargo policy was written to cover motorcycles. The insured got a load of riding lawnmowers as a backhaul back to Milwaukee. Those riding lawnmowers got damaged, and the insurance carrier denied the claim because they were not motorcycles. That's where you want to be as expansive as possible. My father, as most of you know, hauled pickles and cucumbers, but I did not write a cargo policy covering pickles and or cucumbers. I wrote a cargo policy calling food goods and similar items. That's the kind of wording that you want to have. So your underwriting considerations. What's the driver's MVR? That's prone. Also, the pre-employment screening program. This the motor carrier needs to use this even more often. This tells you about the driver's roadside activities, when they got stopped and what they got stopped for. If the insured incorporates the pre-employment screening with proper standards, they will know if the driver secured the cargo properly. It will know if the driver had a crash at fault or not. You got to remember, even if the driver is not at fault, if the cargo gets damaged, the insured is still liable for it. They can't argue that somebody else caused the crash, therefore we're not liable for it. We might be able to subrogate back against the parties who caused the crash, but we, the motor carrier, under CARMAC, is liable for it. You also need to look at the condition of the equipment. Is it properly secured? Does it have the proper suspension? Is it able to be hauled? And one other thing we need to think about is the length of haul. This is something particularly in the theft-prone area, because as we all know, under the hours of service regulation, currently after a driver drives 11 hours or works 14, the difference between those two would be for the driver to stop to refuel, or the time it takes to load the trailer before they start driving. Then they have to rest for 10 hours. So the question is, where are they going to rest? The rest area? Are they going to be at truck stops? Are they going to have to go out and get something to eat? Are they going to have to take a shower? Obviously, they have to use the bathroom. Where are those rest stops being made? And remember, that trailer is sitting there for 10 hours. Therefore, it's more susceptible to theft as it's sitting there and parked in those locations. That needs to be a consideration, too, particularly for us to determine if the motor carrier is managing that on behalf of their drivers and have those set up. Then what's the cargo itself? Every cargo carrier, and for you who are in the insurance industry or who are underwriters know this, you break the cargo down to 4 to 7 different items. You look and see if it's theft prone. You look and see if it's breakable. You look and see if it's perishable. And when I put size here, it's oversized, over length, where you have the determination that's harder to haul. Then the percentage of the loads hauled that fall in those categories is where you get a rate per 100. So those are the things that we need to determine both nature of the cargo, percentage of the nature, and is the driver and the equipment capable of providing the services that are promised for the transportation. And when there is a radius of operation that requires the driver to stop and rest 10 hours, where are they going to be stopping, where are they going to be resting, and what precautions they're taking while they're there from the cargo being stolen. So now let's talk about setting the property up. Auto providing transportation. A lot of times for smaller risks, most of our risks that we write have less than 5 or 10 power units. We make up the make, model, serial, and the limit of coverage provided. We still have some policies out there that say we'll cover the cargo on a trailer that's attached to a power unit. A lot of markets and a lot of brokers don't accept that wording anymore, so there's a number of insurance carriers that have moved from that wording. We'll talk more about that again in the last 4 hours. But you need to watch that, because at least it can be detached for emergency, breakdown. The trailer loses its tires. We're out here in nowhere. The insured has to stop and drop the trailer to go get services to have the tires repaired, or they're having to drop it for loading and unloading purposes, maybe not even in their control. But once they detach it, there's no longer coverage. The ironical part about this, if you talk to loss prevention people from cargo theft, one of the things that you should never do, or one of the things that would protect you from cargo theft, is not to detach the power unit from the trailer. So it's a reasonable consideration to find out if your insured has a practice of detaching or not, but it could be a problem in coverage if the cargo policy itself has that requirement in it. Not listed, we don't list it. We'll say we have covered for all owned units and all non-owned units. Or you can have when the insured's responsible for it. We need, in these cases, to determine what our exposure is by numbers of power units the insured is operating to determine the premium, and therefore we have wording. For a larger risk, just like we do in auto liability, again, $3 million or so. So in $3 million, we're talking about 15 power units or so. Then we'll write on a blanket basis where our premium is not based on knowing how many power units, but are based on their receipts or mileages. We have to set a limit. Cargo is unique in that most of the time the limit is set by the customer. And I've always used this as a joke, because dollar store, as I understand it, the last time that I had some communication, requires a motor carrier to have $1 million worth of limit. My question there is, what is in a dollar store that's worth $1 million that you can put in a 52-foot trailer? Anyway, we have to do that. As an underwriter and as a retail agent, we look at the maximum exposure, but we also need to look at the volume, the value of the items that can be hauled, because we should modify sometimes our pricing not based on the maximum, but based on the actual exposure. We could have, so the shipper sets the maximum, and we will look at the average for underwriting and pricing and determination. There's a few policies out there that have a co-insurance in it. Again, the more modern policies, the more updated policies do not have that anymore, but we have to also watch for the co-insurance. When there was co-insurance, it was typically $100. We'll get more detail again in the last hour. We also need to look at the release bill of lading. Is the shipment under release bill of lading? Particularly if there's a cargo factor, and particularly if there's any kind of limitation that we have in the responsibility to the shipper, that needs to be considered in the limits of coverage that we purchase on behalf of our insured purchases. The insurance agreement, property being covered. This is a legal liability form. Remember, we're buying back our insured's responsibilities as they leave. It's in the written agreement. It's the bill of lading. The question is, does the cargo policy require the bill of lading to be in the name of the motor carrier or not, or just when they're responsible for it? This is a concern Maybe not as much now in the MAP 21, but it was a major concern before that was enforced about a year and a half ago, where a motor carrier would take a load and let another motor carrier haul the load. I looked at some policies lately that says we only cover cargo where the bill of lading is your name, and there's exclusion in the policy that says we do not cover cargo when in the possession of another motor carrier. In this case, because of that wording, there'd be no coverage in this if your insured picked up a load and gave it to another motor carrier without modifying the bill of lading. We need to be concerned about that. Again, the type and ownership, what's being hauled, and who owns what's being hauled. Those things are a major consideration. Then you look at property not covered. Some of you have heard my story before concerning this, which is a major consideration. One of the first commercial policies I ever wrote was for a local beer company. Good friends of mine, still are good friends of mine. They bought trucks from me when I wrote the dealership, and so I wrote my first commercial policy and delivered it to this beer company. And about a week and a half later, the owner of the beer company, again a good friend of mine who knew I was very new in insurance, called me up and says, "Tommy, did you read the policy you delivered to me?" "What are you going to say? Just go have a beer?" I said, "What's wrong, Greg?" He says, "You delivered me a policy covering my beer company that excludes alcoholic beverages." So I delivered a policy to insured that excluded what they were hauling. I learned quickly to read my policies. We had no problem modifying it. We intended to cover that, but I didn't read it. So I learned early in my career that you need to read the policies, and because cargo policies are not uniform, we don't have the ISO auto liability form or GL policy, GL form that we can quote off the top of our heads. We have them different. You have to read them all. You got to find out what's covered and what's not covered and some of the limitations in it, and you want those as broad as possible. You also want to look when in transit. You want to look at the definition. Is it when the insured is responsible for it? Is it when the cargo is on a covered unit? Or when it's being moved? Again, different things there. Some policies do not allow layovers or have some limitations. They only cover point A to point B. These are the high theft items. And if your insured has a terminal, some cargo policies require a separate limit when the items are at the terminal for more than 12 hours or 24 hours. Actually had a case that I was involved in hauling cigarettes out of Winston-Salem, North Carolina to Atlanta. Though picked them up on a Friday to deliver on a Monday. That's about an 8 to 12-hour drive at the most. They took them to their location in High Point, North Carolina, took this load of cigarettes there, put them in their garage, locked the doors of the truck, locked the doors to the garage. But over the weekend, somebody broke in. The insurance carrier did not have coverage because that was the insured terminal, and the policy did not have a separate terminal limit in it. So you need to be concerned about that. Part of the ironical part about it is that it would have been covered if it was at the local truck stop down the line, but at the insurer's location it was not. Again, we ended up modifying, everybody contributed to that coverage because the agent didn't read it, the insurer didn't understand it, things like that. But that's what you've got to look at. And that's because the terminal situation with where you have aggregated a lot of trucks, and or if the insurer keeps them over the limit on a certain period of time, they move from providing transportation to providing warehousing. Also, an operation called cross-docking has to be considered too, because they'll have a terminal and they'll take cargo off of one trailer and put it on another trailer. So if they have terminals like that, if they do things like that, you need to make sure that the cargo policy properly addresses those exposures. So property not covered or limited. Items not in the insurance agreement, there's no protection like the riding lawnmowers. Limited coverage, that's a price consideration. The reason that's there is because the insurance carrier has not properly underwritten it. They don't know what's there, so therefore they got to modify their pricing. Tell the motor carrier, or find out from the motor carrier what they're hauling. Tell the underwriter, and it can be written as long as there's enough protection, as long as the underwriter is comfortable with it, and they can get the premium for the exposure. But those are what's there. So there's other standards. Most commonly found, we don't cover valuable items That's because of money and security. We don't cover things that are hard to set value on: notes, security, valuable papers. We don't carry things with intrinsic value like artwork, or if our insurance hauling them free gratuitously. We also have some limitation of finding some policies commonly done will be livestock or animals, and they vary. Be careful wording this, because when a crash happens with cargo in them, it would normally not be subject to Carmack unless you invoked out of the bill of lading, but you would have to round it up. You'd have to do the straying. You'd have to feed them. And a lot of them say the damage or death has to be done at the accident site. Well, a lot of times the animals create pneumonia and other things, and so therefore it can later. One of the weirdest claims in this area is a load of pigs got stolen by or got taken by PETA in the Washington area and put on a farm, and they refused to give it back unless they were paid $100 a day for feeding those pigs on that farm. Again, how does that handle in cargo? That's just a weird claim with no right adjustment of it, but that's one that is legendary in the industry. Like liquids, a lot of times there's eggs or cotton limitations. If your insureds are hauling any of these particular items, then make sure that you have the proper coverages. Other consideration: heavy haulers have the machinery and rigging. Therefore, you have some consideration where they have to take the blade off the bulldozer, or they have to disassemble items. That should be done with an installation floater, not with a typical cargo policy, because you could be damaged when loading, when assembling or disassembling. Find out your insurance responsibility for loading and unloading, and during the loading and unloading process, either with a forklift. Again, we deal with liability, but you have the same exposure in cargo. When it gets damaged, how's it going to be covered? If your insured has to load it, unload themselves, the driver. In other words, it's not a drop and hook. It's an item where the driver has to unload it either with a forklift or hand truck or those things that you need to make sure if the cargo policy extends coverage to the locations they have to load and unload. I've seen cargo policy says we'll cover it within 50 feet of the carrying compartment. I've seen one that says we'll cover it within 5,200 feet of the carrying compartment. Big a difference. Again, no concern if your insurance in an operation called drop and hook. Major concern if they have loading and unloading responsibility. Containers. These are self-contained items. Most cargo policies, rightly so, exclude intermodal containers, but I've seen others that exclude containers blanketly without intermodal. Those are reusable shipping compartments. You have a lot of your seafood that are shipped in aluminum vats that are reusable. You have chickens on chicken pens, and a lot of times the chicken pens are more valuable than the chicken in them. You have pallets and other things. Your insurance is still responsible for those things, so watch the cargo policy that might exclude those things. Under cargo, we do exclude tarps, chains, and binders. They should be excluded in cargo because they should be covered on the physical damage of the trailers that are used to haul these items. The second cause of loss is theft, and if we have theft, we need to see how it's prevented, and sometimes there are provisions in the policy that says you must do this to have theft coverage. And so you'd have a unit vehicle warranty. You would have the vehicle must be attached to a described vehicle. We already talked about that. Or if not attached, have something on the kingpin, which is the attachment device on the trailer that fits in the fifth wheel, called a kingpin lock. In other words, make it so it's not easy for just the back of another tractor under. You would have something, one of the earlier E&O cases I had is a definition of a attended vehicle. And this would require the vehicle to be attended at all times, or at least with some break for lunch or fueling by the driver or someone who has responsibility to watch it. And that would be a requirement, particularly for the higher value items. You might require team drivers, again, for protection, not from being able to deliver the load. Communication. You could have something called no deviation of routes, meaning they have to go from point A to point B. And a part of this, you have to also look at the employee's dishonesty exclusion in the policy. Some policies have different wording. Again, we'll get that in the last 4-hour section of that wording. If there's high theft items, then you can have some criminal background coverage checks, and then it could be some crime coverage if they get stolen. The problem, you have crime coverage that we write on the standard policies, they cover employees. You would want to modify that to make sure you're including owner-operators or independent contractors and lease workers. So theft is a real concern. Theft is the second cause of loss. It causes a lot of the problems in our industry. Unfortunately, a great number of the times the driver is involved in some way. So therefore, we need to look at our policies to see what needs to be considered in theft and how our insurers need to protect themselves to make sure there's coverage there and to protect the cargo the best way they can so they can limit the theft. We also have in the policy something called debris removal. My question is what's debris? If it's a live presentation where I had audience and I asked you that question, the debris is what can't be salvageable. Debris is what is left there. Therefore, it has to be destroyed. Most policies have a debris cleanup provision in it, anywhere from $10,000 to $25,000. If you do not have enough in the debris coverage in the cargo form, I suggest that you give it back to the auto liability carrier, because in a lot of cases that debris on the ground meets the definition of property damage in our liability form, which says we cover direct damage and loss of use of others' property, and that would be there. Record bills. We will talk about physical damage coverage in a later presentation. Record bills are a major concern. We all know how record bills cause us all problems. Record bills, though, determine about what's damaged and how many units damaged. Typically, you would have a record bill involved in a tractor and or trailer and the cargo. High record bills are typically a derivative of trying to protect the cargo. They're paid in the protect and preserve provisions of the policy. If there's no coverage in the property form, then you might have some liability coverage again for the record bill. But that would be a concern. Do you have enough limits for that? Earned freight recognizes that if the insurer does not deliver the cargo at the proper time and they have a wreck before they get there, the customer's not going to pay them for their mileage they drove between the time they picked it up and when they had the crash or the rate or the loss. Therefore, the cargo policy will pay for that. I've seen those, again, limits $1,500, $2,000, up to $4,000 to $5,000. It depends on if you're running east-west or north-south, depending on what that exposure is. Again, it pays the insured for their cost to move it from the point of pickup to the point of the crash. Pollution damage you find in some policies. This is the pollution cleanup. Typically, there's $10,000. I've seen it as high as $25,000. This is a derivative of being added pollution cleanup in the commercial package policies, and a lot of marine covers adopted that was put in that policy some 10 years ago. The concern you have is where the coverage, if there's coverage in the cargo form, you look at the pollution cleanup coverage, and that's where you'd have direct damage. But we also have the concern of the liability. In this arena, a lot of the auto liability policies we have delivered contain the CA 9948 pollution cleanup endorsement to it that would pay for the pollution cleanup involved in pollution escape of the cargo. Of course, if there's no coverage, then you still might have to clean it up under MCS 90 responsibility, but if you do that with no coverage, the insurance carrier, obviously, we know has the rights of subrogation back. So we want to make sure the coverage is there. My concern is if you have the CA 9948, I have less concern if there's no pollution coverage in the cargo policy or not. That's something we need to look at. Deductibles, again, how many forms will come into place? How many items are destroyed? We don't want 3 deductibles: cargo, physical damage to the tractor, physical damage to the trailer. You want to try to write it with the same carrier when all possible and have a combined or basket deductible. We already talked about if they have a terminal They take their vehicles to that terminal. You want to have a separate terminal coverage and limit. If they have other locations, meaning they have a staging yard they rent or the staging yard they use because they can't get to the factory or to the manufacturer to deliver it, do we have the proper limits? And their warranties. Again, we'll get to those in more detail on the 4th hour, where the insured has coverage and we're concerned about them meeting those coverage requirements and the warranties there. So, coverage consideration. Customer expects everything to be covered. Customers could have requirements on the bill of lading, through the tariff, through the Carmack Amendment. If the Carmack Amendment comes in place, there's coverage for direct damage, not consequential damage. Every policy varies. Customers and brokers understand problem with some insurance carriers' policies and won't accept it. They set the requirements that has to be done. Concern. What's the covered unit? Is it listed or responsible for? Again, the problem requirement of the carrying compartment must be attached. You look at premium versus exposure. It's all legally liabilities consideration. When's the insured legally liable? Is it when it's in their care, custody, control? What's that wording? You don't have a problem as much with drop and hook, except when does it become in their care, custody, control? A customer's requirement, the limits. What is required versus the maximum exposure? Worth more than the requirement of the customer. The insurer can still be liable. So what is being shipped? What's the exposure to loss? What's the cover profit? Information from the insured who are the customers so that you make sure that you're covering those cargo, and the percentage of each. CAB helps us in that area because they capture the inspection from the officers to determine who the customers are and noted in their inspection reports. Theft, added exposure. So what's the driver ability to handle the property? And what's their background check? If it's temperature control, if it's a flatbed, does the driver understand how to hold the property? And again, the Carmack limitations, the just-on-time delivery, or loads from brokers. A lot of times a broker says this is the coverage we have, yet they put a load on the cargo or give a load to a trucker with more value than what is required. The insured is still liable for the full value in the absence of a release bill of lading, even though a lower limit is required. So meeting the customer need. What is the exposure? Items being hauled, susceptible to damage, the driver understand of care, what's it worth? Coverage, property owned, not owned. It's in the insurance agreements, the exclusions and limitations and conditions. Again, we'll watch those in the 4th hour. So each policy will be different. And so for the 4th hour of this session, we're going through the policy review. I hope you got something out of this hour. We look forward to you taking the 4th hour. We're out of here.